Here we are, and yet another week and another all-time high for the S&P 500. This year alone, the S&P 500 has made a new record high over 60 times now. That's 60 new record highs in less than 1 year. Currently, the S&P 500 trades at a price-to-earnings ratio of 29.5 times. Now, of course, that is down from earlier in the year when it was up near 35 times, but historically speaking, the S&P 500 has always traded close to 15 times earnings. Many have asked recently about this next crash. When is the next crash coming? Now, of course, no one knows, but when you really dive into it, we may have already seen a mini crash. When you look at the S&P 500, which is a weighted index, 91% of the S&P 500 holdings actually saw a pullback or a correction of 10% or more from their record highs this year. That's 91%, and that often goes unnoticed due to the fact that the mega cap stocks at the top, your Apples, Googles, Facebook, Teslas of the world, take up such a big chunk of the S&P 500 weighting. Not only am I always on the lookout for undervalued stocks so that I can invest in those, but I also want to bring them to the attention of my followers on Twitter and here on YouTube as well. And in today's video, I'm going to talk about 2 undervalued dividend stocks that you can buy this week for the long term. So make sure you stick around as I dive into the details for both of these stocks. Both of them I currently own and I've recently added to as well, and they're trading at very intriguing valuations. With that being said, let's dive in. Welcome back to the channel. If you're new here and we haven't met yet, my name is Mark Rusin. I'm a CPA, but not a financial advisor. So everything shared on this video today is for educational and informational purposes only. So please do your due diligence before investing in any stock mentioned today. If you're new to investing or looking to open a new account, a regular brokerage account or a retirement account, check out my link below with M1 Finance, where they're running a special promotion right now. For every new account that's opened and funded, they will give you $50 free to start investing. Also, if you're interested in cryptocurrency, check out my BlockFi link below, as all the Ethereum and Bitcoin that I buy, I store right there at Bitcoin because I'm earning dividends. Essentially interest, but we'll call it dividends since I'm a dividend investor. Okay, let's get started with 2 undervalued dividend stocks that are a great buy right now. The first dividend stock that we're going to talk about today is Bristol Myers, stock ticker BMY. One of the most famous quotes that you may or may haven't heard from Warren Buffett is the fact that it's better to buy a wonderful company at a fair price than it is to buy a fair company at a wonderful price. But when it comes to Bristol Myers, I consider them a wonderful company at a wonderful price. Actually, Bristol Myers is in fact a Warren Buffett stock. The company, or I should say Berkshire Hathaway, has within their portfolio about $1.7 billion worth of Bristol Myers, making up roughly 0.6% of the equity portfolio for Berkshire Hathaway. For those of you unfamiliar with Bristol Myers, they are a large pharmaceutical company with a market cap over $130 billion, and they've done over $40 billion in annual sales. In 2019, the company made a very sizable acquisition of another public pharmaceutical company in Celgene, in which they paid $74 billion for. And now they've begun to really integrate that and really expand and diversify the portfolio of products that they have. 65% of the portfolio's revenue is made up of 3 drugs. Here's a look at some of the key contributors for the most recent quarter. Total sales were actually up 10% in the most recent quarter, and this was driven by robust performance from Bristol Myers flagship drugs. Now, I'm probably going to botch the names of these, but Revlimid, Eliquis, and Opdivo saw 11, 15, and 7% year-over-year growth during the most recent quarter. Next, let's take a look at some of the company's profitability metrics. Earnings per share for the most recent quarter was up 23% year-over-year, which was outstanding. In terms of gross margin, Bristol Myers focuses on high-margin products, and they operate with a 12-month gross margin rate of 79.7%. They have an EBITDA margin rate of 43.4% the past 12 months. In terms of the company's balance sheet, they've obtained an A rating. They have $15.8 billion of cash on hand. They have debt of 45.8, and their current ratio is 1.47. The company has operating cash flow over the past 12 months of $15.5 billion, and they have levered free cash flow of $12.1 billion. Bristol Myers pays a dividend of $1.96, which equates to a yield of 3.3%. Over the past 5 years, the company has averaged a dividend yield of 2.8%. In terms of the company's payout ratio, it's currently operating under 30%, which tells management, or me as an investor, that there's plenty of room to grow that dividend moving forward. Speaking of dividend growth, the company has a 5-year dividend growth rate of 5.2%, and they have now increased their dividend for 12 consecutive years. Overall, the company has a very strong and diverse portfolio of products. But pharmaceutical companies have been under intense pressure due to the fact Congress is trying to lower drug prices. And this has some effect on stocks like, or companies like, Bristol Myers. Shares of Bristol Myers have decreased 15% from 52-week highs over the past few months, and the company currently trades at a forward price to earnings of 7.4 times, which is incredibly low, and telling me right now that the company is very undervalued. Looking at the analyst ratings, shares of BMY are rated a buy. The average price target for BMY is $74.17, which implies upside of roughly 25%. Definitely take a look at shares of Bristol Myers because they are trading at an incredibly low valuation. I have continued to add to my portfolio shares of BMY over the past few weeks, knowing that this company has a strong portfolio of products that will fuel them for further growth and further dividend growth moving forward. The second dividend stock we're going to look at today is Visa, stock ticker V. This is a much different dividend stock than what we just looked at with Bristol Myers, which is a pharmaceutical but trading at a single-digit forward price to earnings ratio. Visa is trading at a much higher valuation, but in terms of where they've traded at and the growth that you get from a stock like Visa, this company is very intriguing when you look at the financials. When it comes to dividends, do not judge a book by its cover. Don't just look at the year one dividends. Visa doesn't jump off the screen when you're looking at a dividend yield of less than 1%, but when you peel back the details, you will see that this company is powerful in terms of how they are growing their dividend. The stock is growing at a strong clip, which will keep the dividend yield lower. Because remember, a dividend yield is the dividend rate on an annual basis divided by the stock price. If the stock price is rising much faster than a company can increase the dividend each and every year, then that will continuously show a lower dividend yield, which really it's a positive thing because you're getting share price appreciation with a stock while also getting dividend growth from a stock, which is why I love dividend growth stocks. So a dividend yield has an inverse relationship with the stock price. As the stock price goes up, the dividend yield goes down. As the stock price goes down, the dividend yield goes up. Before we dive into the financials and the fundamentals and looking at all the metrics, let's look at why I believe Visa, the company, is an intriguing business moving forward. The company is directly connected with travel. Now that is just one facet of the business, but as more and more people continue to travel and more borders open up, as COVID restrictions pull back a little bit, we're going to see an uptick in travel. We're already seeing it, but it's nowhere near the pent-up demand that we are seeing from hotels that are out there saying what their bookings are moving forward. This is all positive signs when it comes to Visa. Another area to look at, which is enhanced by COVID, is the use of cash. Now, cash is still used by tons and the majority of consumers out there, but more and more folks are moving to electronic payments. And this directly benefits Visa. Now, you can think about it because due to COVID, we don't want to see the cash-to-cash transactions. That's at least what businesses are saying. When you go through certain drive-thrus now, they don't even want to take your credit card, even if you're paying with credit. They make you insert the chip and pull it out. So this is directly going to benefit companies like Visa, MasterCard, American Express. But today we are going to look at Visa, and not to mention PayPal and Square and companies like that as well. At the end of October, Visa reported their Q4 earnings, which saw payment volume increase 18% year over year, which tells us more and more folks are getting out and getting comfortable to go shopping, go traveling, eating out at restaurants. All of this directly benefits Visa. However, the company did give 2022 guidance, which was below analyst expectation and is the reason why we saw a sell-off in shares of Visa. But again, being a long-term investor, I'm going to look to jump on opportunities that we get in high-quality companies, especially dividend growth stocks. All right, now that we've had a chance to talk about the company and why we see the company performing well moving forward, let's take a look at the financials and the metrics on why this company is a solid buy, but also an undervalued buy. Shares of Visa currently trade at a market cap of $472 billion. The company has a forward price to earnings ratio of 30, compared to a 5-year average of 31.5. So realistically trading a bit below fair value. Looking at profitability, the company operates with a profit margin of 51% and an operating margin of 65%. The company saw a return on equity over the past 12 months at a rate of 33%. In terms of the balance sheet, the company has a very strong balance sheet with $18.5 billion of cash on hand and a current ratio of 1.75, telling me that the current assets outweigh the current liabilities, which is usually a very good sign in terms of a company's financial position. Visa has operating cash flow of $15.2 billion and levered free cash flow of $12.1 billion. In terms of the dividend, Visa currently pays an annual dividend of $1.50, which currently equates to a dividend yield of 0.7%. In terms of dividend growth, this is where I love Visa. Not only does it have strong potential to grow the appreciation of the stock, but you're also going to get very strong, robust dividend growth. Over the past 5 years, shares of Visa, or I should say the management team at Visa, has increased the dividend for shareholders an average of 18% per year, and they have increased the dividend now for 12 consecutive years. Analysts currently rate shares of Visa a strong buy, and this is 13 analysts, which have an average price target of roughly $275, implying an upside over 25%. The highest target right now on the street is over $300 at $305. So this not only tells you that analysts are high on the stock. Now, right now it may be getting beaten down, but if you are a long-term investor, this may be a great opportunity to pick up shares of Visa long-term and enjoy that dividend growth over the years. Another thing I should have mentioned when we were talking about the dividend, we talked about the dividend growth being strong. It's a low yield, but you're seeing consecutive dividend growth now for 12 years. The company has a very low payout ratio of only 21%, and we've already seen the strong cash flows, which tells you that this dividend growth should continue in the foreseeable future. I am someone that is very bullish on Visa because I see in this next year, 2022, how much pent-up demand, just the people that you speak to right now, your neighbors or folks that you come across about these travel plans they have for 2022. I believe the year 2022 is going to be booming for the likes of the travel industry, which directly benefits a stock like Visa. So I am definitely taking advantage of this pullback we've seen in the shares of late. So there you have it. 2 undervalued dividend stocks that you could look into buying right now. Both of them are on opposite ends of the spectrum. You have a pharmaceutical company with a very strong, high margin business that is trading at a forward price to earnings ratio in the single digits at 7 times, which is incredibly low compared to their 5-year average over 15 times. And then you have a stock like Visa. Now, it's a very low yield, so you're not going to get huge dividend income from it in the beginning years, but if you allow this to compound, you also have the opportunity for strong growth from the shares moving forward. The company is increasing the dividend an average of 18% per year right now, and you have a low payout ratio with strong free cash flow to back this up moving forward. So I really love both of these stocks. I have both of them in my portfolio right now, so definitely take a look at those in the coming days to see if they warrant a position in your portfolio. Now, if you enjoyed the video, please give me a big thumbs up, as that'll continue to help us grow here, as we are growing at an incredible pace and we are just building this community of financial freedom where we get to talk about stocks. Let me know if you own either Bristol Myers or Visa down in the comments below. And if you haven't done so yet, grab your free $50 for opening an M1 Finance using my link below, or check out BlockFi if you're interested in getting some free Bitcoin. And with that being said, I hope you enjoyed the video and we will see you next week. Take care.